Let's talk about HEICO Corporation. You know, it's one of those amazing, long-term success stories in the aerospace world. Investors absolutely love it. It's a compounding machine, it's consistent, it's profitable. But there's one kind of glaring issue. Its stock price is through the roof. So for any investor looking at this company, the question is really simple. Is the HEICO machine actually worth that price? Let's dig in.
Okay, so just look at this valuation gap. It is stark. While your average aerospace and defense company trades at a price-to-earnings ratio of about 25, HEICO is way up there, trading at a staggering 76 times its earnings. You know, Wall Street isn't just giving this company a thumbs up. They're pricing it for absolute perfection. They're basically saying it's 3 times better than its average competitor.
So that's the core question, right? What exactly is going on under the hood at HEICO that convinces the market to pay such an insane premium? To figure that out, we've got to break down the business, its competitive fortress, and its really unique growth strategy.
To really get HEICO, the first thing you have to realize is that it's not just one single business. It's more like a beautifully designed machine with 2 distinct, super powerful engines that are working together. So let's take a look at how they're set up.
So, HEICO's revenue is pretty balanced across 2 main segments. The Flight Support Group, or FSG for short, that makes up the bulk of sales at 60%. And then you have the Electronic Technologies Group, or ETG, bringing in a very healthy 40%. Now, even though they serve different markets, they share the exact same strategy. They dominate high-value, niche corners of the market.
So how do these 2 engines actually work? Well, the Flight Support Group is the aftermarket specialist. Its business is tied directly to flight hours. The more planes are flying, the more they need maintenance and replacement parts, and that is FSG's sweet spot. The Electronic Technologies Group, on the other hand, that's the high-tech arm. It makes these mission-critical components for defense, space, and even medical systems. And it's all driven by this constant need for technological upgrades and modernization.
And here's exactly why investors love that FSG segment so much. Its revenue stream is kind of like an annuity. See, as long as the global airline fleet is flying, there is a non-negotiable need to maintain those planes for safety. This creates this incredibly predictable, steady, and resilient demand for HEICO's parts, which helps insulate the company from those wild swings you see in new aircraft orders.
But that annuity-like business, it doesn't just exist on its own. It's protected by one of the most powerful competitive advantages, or moats as investors call it, in the entire industrial world. It's a regulatory fortress, and it's built around 3 little letters, PMA.
So what in the world is a PMA? Well, it stands for Parts Manufacturer Approval. Think of it as a golden ticket from the FAA that legally allows a company that isn't the original equipment manufacturer, you know, like a Boeing or a GE, to make and sell replacement aircraft parts. Without this approval, you simply can't play in HEICO's main sandbox. And getting one, well, that's incredibly difficult.
The barrier to entry here is just incredibly high. A potential competitor has to prove to the FAA that their part is every bit as safe and reliable as the original. And that means going down one of 3 really hard paths. Getting a license from a competitor, which almost never happens, perfectly reverse engineering the part, which is super demanding technically, or going through this grueling test and computation process that's almost like certifying a brand new plane.
You see, this process isn't just a hurdle, it really is a fortress. The immense technical expertise, the capital, the time you need to navigate the PMA process, it all works to shield HEICO from would-be competitors. And that protection is what allows the company to have strong pricing power and generate that high-margin cash flow that fuels its entire growth engine. Okay, so now we understand how HEICO defends its turf. So let's look at how it expands its empire. The company takes all that cash it generates inside that fortress and puts it to work in this relentless and frankly highly effective acquisition strategy.
Just look at that number. Since 1990, HEICO has bought around 98 companies. This isn't a company that makes some big, splashy purchase every few years. No, it is a classic serial acquirer, constantly buying up these smaller, niche, high-margin businesses that expand its product catalog and its tech capabilities.
But what's really unique is the management's philosophy, which they call their owning forever framework. This isn't some private equity firm looking to buy a company and flip it in a few years. No way. HEICO buys businesses to hold and grow as part of its family, and that long-term, owner-operator mindset is just central to its success.
I mean, this chart says it all, doesn't it? Management's priority is crystal clear: reinvestment. Almost all of the cash gets plowed right back into buying more businesses. While the dividend is tiny, it's almost an afterthought. The message to shareholders is that the best way to create value is to keep fueling the acquisition engine, not just hand the cash back. And this is the magic of the model. It's a self-funding flywheel. The existing high-margin businesses generate a ton of cash. That cash is then used to buy new businesses, and those new businesses, well, they start generating their own cash flow, which gets added to the pile to fund even more acquisitions. It's just this beautiful, virtuous cycle of compounding growth.
So, we've seen the quality here. A two-engine growth machine protected by a regulatory fortress and fueled by a brilliant acquisition strategy. This brings us right back to our original question. Is this incredible business worth the incredible price tag?
This really gets us to the heart of the investor's dilemma. On one hand, the reward is owning a business with a truly durable moat, management that thinks like owners, and a proven compounding model. But on the other hand, the risk is that extreme valuation, which leaves absolutely no room for error. And in a cyclical industry like aerospace, any little stumble could be punished severely.
At the end of the day, the primary risk isn't the business itself. It's the price you're paying for it. An investor at these levels is paying for perfection. You're basically betting that this flawless execution can continue forever, and that the company will just keep clearing the really, really high bar that the market has set for it.
So we're left with the ultimate question for any investor. Is HEICO that rare, once-in-a-generation opportunity to partner with one of the great industrial compounders of our time, where the quality is so high it actually justifies the price? Or is it a textbook case of a wonderful business trading at a dangerous valuation, where the risk of a fall is just much greater than the potential for future growth? Well, that's the decision every investor has to make for themselves.